This is the answer to the ACCA P2 June 2008 question 1 on the international paper. I've reworked this question so it's just the consolidation because we're only covering consolidation up to this point. The rest of the adjustments from note 3 onwards, they won't affect the consolidation. So when you're looking at this, if you want to have a go at it first before you check your answer to this video, just do notes 1 and 2 and then prepare the statement of financial position. Forget about notes 3, 4 and 5. I've reworked the statement of financial position ignoring those. So this is just the consolidation, notes 1 and 2 of ACCA P2 June 08 question 1. So it's Ribby, Hall and Zian, and it's a foreign subsidiary. So let's start into the workings and let's see what we need to do for this. Obviously, the first working is always our group structure. So group structure, first working, let's get into it. Looking at the group structure then, the first thing that we need to get down here is the parent. So here's the parent. Well, we can see that Ribby is the parent because they're doing all of the acquiring. So Ribby is going to be the parent. Also get down here the year end. So get the year end down so that you don't make any mistakes when it comes to maybe apportioning the income statement. Now, it's not an income statement in this question, but if you get used to writing that down, you won't make any mistakes. So looking first of all at what Ribby has done, so we see that they have acquired 70% of the ordinary shares of Hall. So let's get that down in our group structure. So 70% of the ordinary shares of Hall. Also get the date down, so 1st of June 2006 is when it happened. So how long have they been part of the group? Well, it's 24 months. So get used again to getting all of that information down so that if there's any time apportionment you have to do, you're not going to make any mistakes. Don't take any shortcuts here. So 70% of Hall on the 1st of June, so they've been part of the group for 24 months. We can also see that we have another subsidiary because Ribby has acquired 60% of Zian. So 60% of Zian again on the 1st of June 2006. So again, they're going to have been part of the group for 24 months. So that's our group structure. Let's just take a minute and get our interests and non-controlling interests sorted so that we don't make any mistakes on that either. I know that this is simple, just getting the interests when it's not a complex group, but again, by getting this information down, it only takes 2 seconds in the exam and make sure that you don't make any mistakes when it comes to the non-controlling interest, for example. So Ribby's interest in Hall, they have just a direct interest, it's 70%, so that leaves the non-controlling interest at 30%. Just tot it up just to be sure you haven't made a mistake, and yes, there it comes to 100. For Zian, the direct interest is 60%, leaving the non-controlling interest of 40%, and again, tot it up just to be sure. So it only takes a second to make sure that you don't make any mistakes further on down. So let's move on then. We've got enough information here, we can do our working twos, our equity table to work out the net assets in each of Hall and Zian. Looking first of all at the equity table for Hall. So we are first of all told that the fair value of the net assets were 120 million at the date of acquisition. So we know that the total down at the bottom here at acquisition is 120. So let's stick that in so that when we come to do our calculations, we'll see what the difference is. So the share capital we can take from the statement of financial position. There hasn't been any change, so it's 40 at acquisition. The other reserves, we're told that at the date of acquisition, the reserves were 10. So we're told that in note 1. We're also told that the retained earnings were 60. So looking at our total there, 40 plus 10 plus 60, well, there's a difference. That doesn't add up to the 120 that we are given in note 1. But we're told the excess of the fair value of net assets is due to an increase in the value of non-depreciable land. So the land there will be the balancing figure of 10. So that's where the 10 is made up. It's the 120 of total net assets less the other information that we're given. So the land of 10 is a fair value adjustment. We then get our details at the reporting date from the statement of financial position, share capital of 40, other reserves of 10, retained earnings of 80. Lastly, we get in the 10 of the fair value on land, no depreciation because it's non-depreciable land. Get the total of that and it's 140. So that's our equity table, our net assets at acquisition and at the reporting date for Hall. We now need to look at Xi'an. We can see that Xi'an is in a foreign currency. So remember, thinking back to our lecture, we always do our equity table to work out the net assets in the foreign currency. But the other thing we need to remember is that if we see a foreign subsidiary like this one, we need to look out for loans between the parent and the subsidiary. And if we see one, we need to do the working now because the loan will result in a foreign exchange gain or loss when it's retranslated at the year end, and that will affect our net assets at the reporting date. So once you see a foreign subsidiary, look on down the notes and see if you can see a loan. And sure enough, in working 2, we see that there's a 4 million loan between the parent and the subsidiary. So actually, before we fill this in, let's do that working on the loan to make sure that we don't leave it out so that we can get it in to our net assets at the reporting date. So let's look at the loan in note 2. Looking at that loan, it's from Hall to Xi'an. So Hall has lent $4 million to Xi'an. So what's going to happen is that we'll need to remove that loan, but there'll be a retranslation of the loan at the year end in Xi'an's accounts. So when they retranslate that loan at the year end, there'll be a foreign exchange gain or loss that will increase or decrease net assets at the year end, and we'll need to bring that into our working 2. So the loan at the date raised, well, at the date raised, the foreign exchange rate was 10. So the 4 million at a rate of 10 was 40 dinars. At the reporting date, the foreign exchange rate has changed to 12. So the 4 times 12 is 48. So we can see that there's a foreign exchange loss because they now owe more than they did before. They now owe 48 dinars when they did owe 40. So that gives us a foreign exchange loss of 8. So that's going to reduce our net assets at the year end, and we need to take that into our working 2. We can now move on to do the equity table to work out our net assets. Remember, this is in the foreign currency. And we see from note 1 that the total net assets at acquisition are 495 million dinars. So that's what we're looking for. So all of our net assets at acquisition are going to add up to that. And just like Hall, any difference will be the fair value of land. So we'll need to adjust for that. So the share capital was 209. We're told that other reserves, there are none. The retained earnings at that date are 220. And then we have the fair value of land to make up the balance. So it's a balancing figure. The 495 less 220 less 209 gives us 66. So that's the fair value adjustment. We then need to do our net assets at the reporting date. Share capital 209 hasn't changed. Retained earnings, we can see from the question, are 299. The land is still 66. And then we need to bring in our foreign exchange loss on the loan. And we've done that calculation in our working 6 that we've just done. So it was 8. So adding those up, we get the net assets at the reporting date of 566. Moving on to goodwill. We're not given a fair value of the NCI, so we're going to use proportionate goodwill. And the goodwill in Hall is fairly straightforward. We simply take the cost of the investment in Hall, which was 98, less the parent's percentage of the net assets at acquisition. The net assets at acquisition come from our working 2, and they were 120. The parent's percentage is 70%, so that gives us 84. So that gives us goodwill in Hall of 14. So we now need to look at the goodwill in Xi'an. The goodwill in Xi'an needs to go through the 3-step process that we talked about in the lecture. So step one, the cost of the investment. Well, looking at the statement of financial position, the investment in Xi'an is given in dollars, and we need to do our goodwill working in dinars. So we need to translate the cost of the investment from dollars into dinars at the acquisition rate. We're given the acquisition rate of 11. So 30 is the cost of the investment times 11, which is the acquisition rate, gives us 330. So 330 dinars. We need to take the parent's percentage of net assets from working two. Remember, we did working two in the foreign currency, so it's straightforward. We take the 495 times the 60%, which gives us 297. So that gives us our goodwill of 33. So our step one was to translate the cost of the investment. Step two is to calculate the goodwill and translate it at the closing rate. So we always translate the goodwill at the closing rate to bring in to the statement of financial position. So the goodwill is 33. The closing rate given to us in the question is 12. So that's $2.75 million. And that's what's going to go to our statement of financial position for the goodwill in Xi'an. The last step is to translate the parent's investment. So retranslation of the parent's investment. We take the investment at the acquisition rate, which is the 330 dinars divided by 11. Remember, we're trying to get it into dollars to get a foreign exchange gain or loss in dollars. So 330 at the acquisition rate of 11 gives us the 30. We'd expect that because that's what it's in the parent's accounts at. Now we need to compare that to the investment at the closing rate. So again, the 330, but this time at the closing rate of 12 gives us 27.5. The difference between the two is the loss on translation. That loss on translation is going to go to working 5 and it is 2.5. So that loss on translation is in dollars and it goes to working 5. So that's the three-step process for any of these questions on a statement of financial position. The cost of the investment to work out the goodwill is first of all translated at the acquisition rate into dinars so that we can do that goodwill working in the foreign currency. We do the goodwill working and translate the goodwill at the closing rate to go into our statement of financial position. We then retranslate the cost of the investment by taking it at the acquisition rate, comparing that to the closing rate, and taking the gain or loss on translation to our working 5. So learn that three-step process and know how to apply it. Moving on to working 4, our non-controlling interest. Well, the difficult bits of this question are done. So the non-controlling interest is simple. All we do is we calculate the non-controlling interest in the foreign currency, and then we translate it at the closing rate. So we don't need to do that for Hall. They're simply the non-controlling interest percentage of their net assets at the year end. That'll come from working 2. So their net assets at the year end, we calculated in working 2 as 140, and times the 30% gives us 42. When it comes to Xi'an, we take the net assets at the year end, the non-controlling interest percentage, which is 40%, times the 566 of net assets, and then translate that at the closing rate of 12. So that's 18.87. So adding those up gives us 60.87 for our non-controlling interest. Our working 5 for retained earnings is relatively straightforward. Same as usual, we start with the parent's accumulated profits of 120. We then need to bring in Xi'an's. Now we bring those in at the closing rate. So we simply take the 71 of profit, we translate it at the closing rate of 12, and we times that by 60%. So the 71 will come from our working 2, which will be the profit post-acquisition. So since acquisition, they've earned 71. Translate that at 12 and take the 60% of it for the parent's share, and that's 3.55. The share of Hall, well, they have 20 post-acquisition profit times 70% gives us 14. Don't forget to bring in the foreign exchange loss on the cost of investment that we calculated in working 3, which was 2.5. And adding that all up gives us 135.05. So that now enables us to finish and complete our statement of financial position. If there are a few adjustments and translations to do, it may be an idea to do a separate working to translate your foreign subsidiary. So before we just complete the statement of financial position, I'll show you how to do that. So we have a working here to do the translation of Xi'an. So what we're going to do is simply go down the statement of financial position, take the amount in dinars and any adjustments that we need to make given the consolidation workings that we've done, and then translate it at the appropriate rate. So property, plant and equipment, well, taking that from the question, we have 360, but in working 2 we had a fair value adjustment on the land, so that was moving upwards by 66. So the total property, plant and equipment was 426. The rate we're going to use is the year-end rate. Remember, all of the statement of financial position for a foreign subsidiary is translated at the year-end rate, which is 12. So translating the 426 at 12 gives us 35.5. 426 divided by 12, 35.5. The financial assets, well, they're 148. We don't have any adjustments, so the total is 148. Translated at 12 gives us 12.33. The current assets, we have 120, but we don't have any adjustments, so they stay at 120. Translated at 12 gives us 10. Non-current liabilities, this time we have 48, but we also have an adjustment of 8 because our non-current liabilities have gone up because we owe extra on that foreign loan. Remember, the foreign loan has gone from 40 to 48 for the foreign exchange difference, so that gives us 56. So that was working 6 where that came from. So the rate is 12. So translating that gives us 4.67. Current liabilities were 72, no adjustments, so 72 translated at 12 gives us 6. So if it's a long and complicated question, maybe best to have a separate working to do your translation of the subsidiary so that you can just bring these figures then into your final statement of financial position. So let's do that now. So looking at our statement of financial position, we have Ribby, Hall and our translated amounts for Xi'an, which we've brought in from our working 7. For the goodwill then, don't forget to bring it in. We have 14 for Hall and 2.75 for Xi'an. That comes from working 3 above. So the group amount of goodwill is 16.75. The property, plant and equipment, well, we have an adjustment of 10 and that's for Hall. Remember that we have already adjusted Xi'an for their fair value of 66, but we also have a fair value adjustment for Hall coming from working 2 and it was for 10. So adding those across gives us 415.5. The financial assets, well, remember again there's the loan between Hall and Xi'an, so we need to take that out because it's an intercompany balance. So taking that out, adding those across comes to 23.33. The current assets, well, we just add those across and that comes to 49. So we have our total assets of 504.58. Moving on to our equity and liabilities, we first of all have our ordinary shares. Remember, that's always the parent only. Other reserves, well, they are parents as well, 30. The retained earnings come from working 5 and we calculated those as 135.05. The non-controlling interest comes from working 4 and it was 60.87. Non-current liabilities, well, remember again to remove the loan of 4, so adding that across comes to 95.67. And the current liabilities are simply added across, coming to 123. So adding that up comes to 504.59. Very slight difference just due to rounding. So that is the answer to our June 08 question 1, just the consolidation. Make sure that you're happy with all of those workings, because if there's a foreign subsidiary and it's a statement of financial position, most of the adjustments are covered in this example.